Yo guys, Leggy here, and this week I have been going through my various pies and my investments. So basically, today I'm going to be talking about REITs. What are REITs? They are real estate investment trusts. So from Investopedia, this is a company that owns, operates, or finances income generating real estate. And why would you want to get a REIT? Basically, I have been banging on about diversification and the importance of it, and REITs are shown to actually have less correlation to the stock market. This decreases risk as they are shown to have lower volatility. And they also pay regular dividends back to the holders. So a dividend is basically a cash payment paid back to the investor. So let's have a look at the history of the returns of REITs compared to S&P 500. S&P 500 is the 500 largest stocks in America, and it's used as a benchmark for most investors. So from 1972 to 2023, the S&P 500 has averaged 10.2%, whereas REITs have averaged 12.7% over the last 25 years. The S&P 500 has averaged 7.6%, and the REITs have averaged 11.4% over the past 20 years. The S&P 500 9.7%, and the REITs have performed slightly better at 10.4%. Although it comes to the most recent period of time in the last 10 years where the S&P 500 has performed way better than REITs. And REITs are really struggling at the moment. And why is this? So interest rates have been rising, which I have been on about for the last few videos as well, as it is a very common theme at the moment. And a big driver of why stocks are performing as they are. So REITs actually tend to have a lot of debt, and basically when interest rates are high they have to refinance this debt. This makes it not a very good hold in periods where there's high interest rates. This makes these companies a longer term hold. So from this report by the S&P Dow Jones Indices, it says that it's commonly asserted that REITs are destined to underperform when interest rates rise, which is what we have seen since 2021. Basically, we've seen a massive rise in interest rates. So the key takeaway from this is basically people invest in REITs in order to get the high dividend yield they give, although when interest rates are high, this basically makes the high dividend yields by the REITs a lot less attractive because people can get these sorts of returns from fixed interest securities. So as well as looking at REITs as a whole, it's important to know that REITs have subgroups, and I'm going to stick a table on here because it's really interesting. So if you look, self-storage has had the highest average return, but what's actually really changing is it's really important to look at office space REITs and understand that demand is actually diminishing for these. But ever since the pandemic, obviously more people have been working from home, and this has meant that office REITs have really been struggling. So what could be found is that, this, although it's managed to keep up with the S&P 500 historically, demand for this might further diminish and it might struggle in the future. So I've been trying to sort of stay away from office focused REITs. So I spoke a little bit yesterday about basically there being an election in England and it not looking likely for any rate cuts anytime soon. So basically, in England, it looks like the energy costs are going down, high services, inflation concerns, and wage growth remains high. All have acted as factors for why rates don't look like they're going to be cut anytime soon. In relation to America, there were some minutes taken from a meeting which had a pessimistic view on any rate cuts in the near future. And if we look at our portfolio, you can see the point where these minutes were released and this news was announced, because there's been a real dip in the market in the last day. And if I take us to this tweet here, it says, tech was the only sector that saw gain today, now getting a bit close to the Comserve's year-to-date gain of nearly 20%. REITs fell most today and continue to hold last place spot year-to-date. Small caps struggled relative to large caps, led to downside by Russell 2000 value. So as you can see, REITs are really struggling at the moment, and their poor performance this year is why I think they're such an important asset class to look at. So if we look at Realty Income, which is our largest holding, Basically, you can see over the 1 year mark, it's 13% down, which is quite a lot. And I'll put the other holdings we've got here, and none of them are performing particularly great. I like Vici Properties because it's looking into gaming and golf. Stag is a very reliable dividend payer monthly as well, like Reality Income. American Tower has been a very interesting hold. Why is Reality Income our largest holding? Well, they've got a history of never reducing their dividend or cancelling it in periods of recession. And it obviously pays a regular dividend. It pays monthly, which obviously gives an investor a nice bit of cash every month. So basically, in conclusion, I'm really interested in building my position for the long term in this asset class, but with the pessimistic view that has come out from where the UK stands and the news from the Federal Reserve minutes, I can't see rates being cut anytime soon. And rates being cut is the driving force that would bring the price of REITs up. So yeah, I think that we'll have to wait for rates to be cut. How long that will be is very interesting. So this could be something that, we just build in the background, and when it happens, it happens. But I think it is important because it diversifies us from other stocks. But yeah, guys, that's my opinion. I hope you guys did enjoy it. Please leave a like and subscribe, and I'll see you guys next time. Peace.